Welcome back to the deep dive. Sometimes we tackle topics that maybe seem a little dry on the surface, like tax forms.
Definitely not the most exciting beach reading usually.
Right. But here at the deep dive, we love digging in because honestly, beneath that official jargon, there's often, well, hidden knowledge, maybe some surprising details, and yeah, real opportunities if you know where to look.
Mm.
So today, we're not just looking at instructions, we're kind of decoding one of the most impactful forms for small businesses. We want to turn this chore into, well, something strategic.
Exactly. Our mission today is to really give you a solid grasp of Form 1120S. That's the U.S. income tax return for an S corporation.
Okay.
And we're going beyond just the basics. We're going to dissect it,
Yeah.
really focus on finding those key spots for potential tax savings, and also making sure the preparation is, efficient and compliant. Think of it like a blueprint for your S Corp's financial health.
And hey, before you think, oh, but I don't have an S Corp, just hang on.
Yeah, good point.
Because even if you're not filing this specific form, the principles we're unpacking today, like how to navigate complex tax stuff, spot chances to optimize, avoid common mistakes, these are skills that honestly apply everywhere. Business, personal finances, you name it.
Absolutely. It's about understanding the system.
This deep dive is really about unlocking hidden value in what looks like just, well, paperwork. And we're getting our insights straight from the source, the actual IRS instructions for Form 1120S. So let's jump in. The S Corporation Foundation. Why Form 1120S matters. Okay, let's unpack this form then. Form 1120S, what exactly is it for? Why is it so foundational for businesses that choose this S Corp route?
Right. So fundamentally, Form 1120S is the annual report card, let's say, for a domestic corporation that's elected S corporation status.
Okay.
It's where the business reports everything financial: income, gains, losses, deductions, credits, the whole picture. But the reason it's so popular, why it even exists, is the S corp structure itself. Unlike a traditional C corporation.
Which gets that double taxation.
Right. Exactly, that dreaded double taxation.
Yeah.
Where profits get taxed at the corporate level and then taxed again when shareholders get dividends. And S Corp avoids that because it's a pass-through entity.
Pass through, okay.
Meaning the profits and losses,
Yeah.
they aren't taxed at the company level. They just pass right through to the owner's personal income tax returns.
Ah.
So a huge built-in tax-saving mechanism of the S Corp is simply avoiding that corporate tax rate. For a lot of small and medium businesses, that's a significant reduction in their overall tax burden. No second layer of tax.
That pass-through idea sounds really efficient. So if a business decides, hey, we want to be an S Corp, is it just like a switch they flip? Or is there a process?
Oh, it's definitely a formal process. Usually pretty straightforward, though. It starts with filing Form 2553.
2553. Got it.
Yeah, election by a small business corporation. You file that with the IRS, and it's absolutely crucial that the IRS formally accepts the election. Once they do, that S Corp status generally stays put indefinitely, really.
Until it doesn't.
Right, until it gets terminated. And this is where S Corp owners really need to pay attention. Understanding how that election can be terminated sometimes automatically is key, because the tax consequences can be pretty major and, frankly, unexpected.
Unexpected tax consequences.
Okay.
That sounds like something to avoid. What are the common ways this S Corp election gets tripped up, especially without owners maybe even realizing it? How do you prevent that?
Yeah, there are three main ways it can automatically terminate. First, the corporation just stops being a small business corporation, according to the tax code, section 1361B.
Okay, what does that mean practically?
It's pretty specific.
Yeah.
Generally, an S Corp can't have more than 100 shareholders. And there are strict rules about who can be a shareholder, like no partnerships or other corporations generally.
Hmm.
Also, only one class of stock is allowed, though different voting rights are okay. If you suddenly fail those basic tests, maybe you bring on too many investors, or the wrong type of investor, poof, the S election terminates. So the takeaway is, always monitor your shareholder count and who they are, especially during ownership changes.
Makes sense. What's the second way?
The second one is a big tax trap, especially if the business used to be a C Corp. It involves two things happening together: having accumulated earnings and profits, or AE&P, left over from the C Corp days.
Okay, old profits.
Right. And also having passive investment income make up more than 25% of its gross receipts. If that happens for 3 consecutive tax years,
3 years in a row.
3 years in a row, your S Corp election terminates, and it terminates starting the next tax year after that third year. Plus, the corporation has to pay a penalty tax for each of those 3 years it had what's called excess net passive income.
Wow. Okay, can you give an example?
Sure. Imagine a C Corp, maybe a manufacturer, sells off its main operations. They convert to an S Corp, but still have a chunk of retained earnings from the C Corp days sitting on the books. Now, the company mostly just holds investments, collecting interest, dividends, maybe some rent. If that passive income keeps being more than 25% of their total income year after year, while they still have that old AE&P, uh-oh is right, they could suddenly lose their S election and get hit with a corporate-level tax on that excess passive income for those years. It's subtle, but it happens. A big pitfall.
Definitely something to watch out for if you converted from a C Corp. And the third way?
Third is voluntary revocation. That's simpler. Shareholders who hold more than half the stock, including non-voting stock, just need to formally agree to revoke the S status.
Okay, they choose to end it.
Right. They can usually pick an effective date, too.
Yeah.
So yeah, understanding these triggers, automatic or voluntary, is just crucial for keeping your S-Corp status and avoiding nasty tax surprises.
So being proactive is really the name of the game, especially with that C Corp history. Okay, let's get practical. For anyone filing this Form 1120-S, when is it actually due? And what if a business, closes down?
Good question. Generally, the due date is the 15th day of the third month after the end of the corporation's tax year.
So for most businesses on a calendar year, that's March 15th.
Usually, yes, March 15th. For the 2025 filing, March 15th is a Saturday, so the actual deadline gets pushed to the next business day, which is Monday, March 17th.
Okay. And dissolved corporations?
They still need to file a final return. That's due by the 15th day of the third month after the date they dissolved.
And filing these days, I assume it's mostly electronic. Is e-filing required?
Generally, yes. E-filing is usually mandatory for Form 1120-S. But there's this really interesting kind of unique waiver. If using the technology required for e-filing genuinely conflicts with sincerely held religious beliefs, the corporation can actually get an exemption.
Really? How does that work?
You just write religious exemption clearly at the top of page 1 of the paper, Form 1120-S, and mail it in. It's specific, probably rare, but it shows how the IRS does consider, well, various situations.
That is surprising detail. So, okay, if you are mailing it in or just sending correspondence, where does it go? Does it matter how big the company is?
It absolutely does. The where does file address depends on your total assets and if you're filing a complex schedule called Schedule M3.
M3, okay.
Right. If your assets are under $10 million and you're not filing Schedule M3, it goes to Kansas City, Missouri. But if you have $10 million or more in assets, or if you are filing Schedule M3, then it goes to Ogden, Utah.
Okay, why does that little detail matter so much?
Because sending it to the wrong place, or even just assembling the return incorrectly, like putting schedules in the wrong order, can cause processing delays, errors, maybe even trigger penalties down the line.
Yeah.
Getting it to the right place, put together correctly, it's a small thing, but it avoids headaches.
Attention to detail saves grief. Got it. Speaking of details, what about paid preparers? If you use one, what's their role? And what about that little yes box for paid preparer authorization? What does that actually let them do? I'm curious about the limits there.
Yeah, that's important. If you pay someone to prepare your return, they generally have to sign it and include their preparer tax identification number, their PTIN. They also have to give you, the taxpayer, a copy.
Right.
Now, that paid preparer authorization box, checking yes, gives the IRS permission to talk about that specific tax return with the specific individual who signed it, not their whole firm, just that person.
Okay, limited permission. What can they discuss?
The IRS can call them to answer questions during processing, maybe get some missing info, check on the status of a refund or payment, or respond to basic notices about math errors or offsets.
Okay, so what can't they do? This sounds like the important part for delegation and liability.
Exactly. Here's the key aha moment. Checking that box does not authorize the preparer to get your refund check for you. It doesn't let them bind the corporation to anything, like agreeing to more tax liability. And it doesn't let them represent you before the IRS in any formal way beyond just discussing that returns processing.
So no audits or appeals?
No. For anything like that, you need a separate Form 2848 power of attorney. This authorization is very limited, and it automatically expires by the due date of your next tax return anyway. So yeah, understanding those boundaries is really vital.
That's a critical distinction. Okay, but what happens if you or your preparer don't follow all these rules? What kind of penalties are S-Corp looking at for, say, filing late or making mistakes? This sounds like it could eat into any tax savings pretty fast.
Oh, penalties can be really steep. And avoiding them is a tax saving strategy in itself, right? Every penalty dollar is a dollar lost.
True.
So first you've got the late filing penalty. If the return is late, or doesn't have all the required info, it's $245 per month or part of a month. It's late, up to 12 months.
Okay.
And that $245 gets multiplied by the number of shareholders the corporation had during the year. So even a small S-corp with, say, 4 shareholders is looking at nearly $1,000 a month just for being late.
Oh.
And if tax is actually due on that late return, there's an extra penalty, 5% of the unpaid tax per month, up to 25%.
Wow. Okay, what else?
Then there's the late payment penalty. That's 0.5% of the unpaid tax per month, also capped at 25%. Now, sometimes you can get these waived if you show reasonable cause, but you can't count on it.
Reasonable cost. Not always easy to prove, I imagine.
Exactly. And here's another big one that hits shareholders directly. The failure to furnish information, timely penalty. That's for not giving shareholders their scheduled K-1 on time, or if the K-1 is missing required information. There's a pretty hefty penalty per K-1.
Per shareholder.
Per shareholder per K-1. And if the IRS thinks you intentionally disregarded the requirement, the penalty gets even bigger. It's a strong incentive to get those K-1s right and out on time because your shareholders need them for their own returns. So yeah, timely, accurate K-1s protect the corporation's bottom line.
Good point. Any others?
One more to be aware of, though it's not directly on the 1120S itself, is the trust fund recovery penalty. This is serious. It applies to payroll taxes, the income tax, Social Security, Medicare withheld from employee wages aren't collected or paid over to the IRS.
Ah, payroll taxes.
Right. The penalty can be assessed against the individuals responsible for making sure those taxes get paid.
Yeah.
It underscores how critical payroll tax compliance is. All these penalties really drive home that being diligent isn't just about rules, it's fundamental financial management. 2. Strategic financial reporting. Accounting methods and activity limitations.
Ah, okay. That's a pretty thorough and maybe a little intimidating look at penalties. But let's shift gears. Let's talk about something more strategic, more in the nuts and bolts of daily operations. Choosing your accounting method. This sounds like where things get really interesting for the bottom line. How do S-corps choose, and what are the rules?
You're right. This is definitely where tax planning meets the day-to-day. S-corps, like other businesses, have to figure their income using the method they consistently use for their own books. And that method has to clearly reflect income.
Clearly reflect income. Okay.
The usual choices are the cash method, the accrual method, or, sometimes other specific methods the IRS authorizes. But there's some key restrictions, and more importantly, some really significant opportunities for tax savings, depending on how you're classified.
Okay. Restrictions and opportunities. Tell me more.
Well, for instance, an S-corp generally can't use the cash method if it's considered a tax shelter. That's a specific definition we won't dive too deep into now, but it's a restriction.
Mm-hmm.
And for businesses with inventory, the accrual method is usually required for tracking sales and purchases of inventory. But, this is a huge but, that mandatory accrual for inventory doesn't apply if the S-corp qualifies as a small business taxpayer.
Ah, there it is again. Small business taxpayer. That sounds like a label everyone wants. What exactly makes an S-corp a small business taxpayer? And what kind of relief does that bring? What's the aha moment here?
It's absolutely a classification you want if you qualify. It offers really significant relief. A small business taxpayer is one that first has average annual gross receipts of $30 million or less for the 3 prior tax years.
30 million or less, average. Okay.
And second, isn't a tax shelter. If your S-corp meets both those tests, you are not required to use those complex uniform capitalization rules, often called UCR, for your inventory.
And that's a big deal because
It's huge. It simplifies your accounting immensely. But more than that, it's a potential tax deferral. Instead of capitalizing those inventory costs and deducting them slowly over time, you can often deduct them much more quickly.
so better cash flow.
Exactly. Better cash flow. Imagine a growing online retailer staying under that $30 million threshold. They avoid tying up money and time in complex inventory accounting. They can deduct costs faster. That's real financial freedom. Plus, small business taxpayers can usually change their inventory accounting method more easily, often just matching their internal books. The IRS even has automatic consent procedures for this. It's a direct path to tax savings through simplicity and potentially faster deductions.
Okay, so being a small business taxpayer is definitely a goal, lots of benefits. But what if you don't qualify or you just want to switch methods for another reason? How does an S-corp change its accounting method?
Generally, you need the IRS's permission, their consent, to change either your overall accounting method or how you treat any significant item.
So you can't just decide one day.
Nope. You typically have to file Form 315-SON, Application for Change in Accounting Method. And you usually file it during the tax year you want the change to take effect. Now, some changes do get automatic consent, but you still have to follow the specific IRS procedures. It's not something to do lightly without checking the rules.
Okay, Form 3115, good to know. Now let's tackle another area that seems to trip people up. Those at-risk limitations and passive activity limitations. How do these work for S-Corp, especially since they pass through? What do shareholders need to know?
Right, this is where that pass-through nature really matters. The at-risk rules and the passive activity rules, they don't apply at the corporate level. The S-Corp itself doesn't worry about them.
Ah, okay. So it's a shareholder thing.
It's entirely a shareholder-level issue. This is critical. It means a shareholder's ability to actually deduct losses passed through from the S-Corp can be limited. First, by their at-risk amount, basically, how much skin they have in the game, their investment plus certain loans. And second, by whether the activity generating the loss is considered passive for that specific shareholder.
Passive. Okay, what's the gist of the passive activity rules?
The core idea is this. Losses and credits from passive activities can generally only be used to offset income and tax from other passive activities.
So passive losses need passive income.
Exactly. If you have a passive loss from your S-Corp, maybe it's from a rental property you own through the S-Corp but don't actively manage this, you generally can't use that loss to reduce your taxes on, say, your salary or your wages, or what's called portfolio income, like interest and dividends.
So those losses get stuck.
They get suspended, basically. You can carry them forward to future years to offset future passive income, but they don't give you immediate tax relief against your active or portfolio income. It's a key area for tax planning.
Okay, passive losses can be a pain if you don't have passive income. Are there any major exceptions? Especially for real estate. That seems like a common S-Corp activity.
Absolutely. And this is a really powerful tax-saving strategy for the right people. There's a big exception for qualifying real estate professionals.
Ah, okay. How does that work?
If a shareholder meets specific, quote, strict criteria, they might be able to deduct rental real estate losses against their non-passive income, potentially up to $25,000 per year, although that phases out at higher income levels.
What are the criteria?
Two main conditions. First, more than half of the personal services they perform in all their trades or businesses must be in real property trades or businesses where they materially participate.
Materially participate, meaning they're actively involved.
Right. And second, they have to perform more than 750 hours of service during the year in those real property trades or businesses where they materially participate.
Okay, half their time and over 750 hours.
Both conditions must be met. And if they're married filing jointly, one spouse has to meet both tests on their own. It doesn't combine. But if they qualify, it can turn those otherwise suspended passive losses into valuable current deductions against other income. Big tax impact.
Definitely worth looking into if you're heavily involved in real estate. So what counts as a rental activity generally? And are there exceptions there too?
Good question. Generally, if the main source of income from an activity is people paying to use tangible property, real estate, equipment, whatever, it's a rental activity.
Okay.
But there are several important exceptions where it's not treated as a rental activity for these passive loss rules, even though rent is involved. For example, if the average time a customer uses the property is 7 days or less, think short-term rentals, like maybe renting out tools or a car for a few days.
Okay. Like Airbnb, maybe?
Potentially, depending on the average stay. Or if the average use is 30 days or less and you provide significant personal services. Think like a hotel providing daily cleaning, room service, etc. Also, if you provide extraordinary personal services, making the rental part minor. Or if the rental is just incidental to a non-rental activity, like holding land mainly for appreciation, but renting it out minimally. These exceptions are crucial because if an activity isn't technically a rental activity, then whether it's passive depends on the shareholder's level of participation, not just the nature of the income. It gets tricky.
That does sound like an area where you need to know the details. What about this term, recharacterization of passive income? That sounds complicated.
It can be, yeah. But it's designed to stop taxpayers from gaming the system. Basically, you can't just easily create passive income solely to soak up your passive losses.
Okay, how does the rule work?
The rule says that the net income from certain specific types of activities, even if they look passive on the surface, must be treated as non-passive income. It gets recharacterized.
So income you thought was passive suddenly isn't.
Exactly, which means you can't use your passive losses against it. It's an aha moment because it changes how that income fits into your overall tax picture.
What kind of activities get recharacterized?
Common examples include renting property, where very little of its value is depreciable, like renting out land, or income from renting property to a trade or business, where the shareholder also has a significant ownership interest.
Ah, renting to your own business.
Right. The S-Corp needs to flag these types of income on the Schedule K-1 it sends to the shareholder, because ultimately it's the shareholder who has to apply the recharacterization rules on their personal return. Clear communication from the S-Corp is key here.
Seems like a specific anti-abuse rule. Okay, what about grouping different business activities together? Can S-Corp do that, and how does it affect these passive rules?
Yes, they can. The IRS lets you group different activities together if they form an appropriate economic unit.
Appropriate economic unit, what does that mean?
It's based on facts and circumstances. Things like, are the businesses similar? Is there common ownership or control? Are they in the same geographic area? Do they rely on each other?
Okay, give me an example.
Sure. Let's say an S-Corp owns a bakery in Baltimore and another bakery in Philadelphia. It could probably group those two bakeries into one single bakery activity.
Makes sense.
Or maybe it owns a bakery and a movie theater in Baltimore and also a bakery and a movie theater in Philly. It might group them by location, Baltimore group, Philly group, or by type of business, bakery group, theater group.
So there's some flexibility.
There is flexibility.
Yeah.
But here's the catch. Once you choose a grouping, you generally have to stick with it in future years. You can't just change it willy-nilly unless the first grouping was clearly wrong or circumstances materially changed.
Okay, consistency matters. Is there a warning here?
Definitely. The IRS can step in and regroup your activities if they think your grouping isn't really an appropriate economic unit, and if a major reason you group them that way was just to get around the passive activity limits.
So no artificial groupings just for tax reasons.
Right. They want to prevent manipulation. And there are limits, too. Like, you generally can't group a rental activity with a regular trade or business activity unless the rental part is really small or meets some very specific ownership and usage tests. It's all about keeping passive income and losses properly separated.
Okay, strategic grouping is okay, but not just to play games. What about portfolio income and this thing called self-charged interest? How do they fit in?
Portfolio income is relatively straightforward. It's your classic investment income interest, dividends, royalties, annuities, capital gains from selling investments.
Stuff not from the main business operation.
Exactly. The key thing for an S-Corp is that this portfolio income and any expenses directly related to it get reported separately on Schedule K. They don't go on page 1 of the Form 1120-S with the main business income and expenses.
Why this separation?
It's important for the shareholders. They need that portfolio income broken out separately to figure out things like their investment interest expense limitation on their personal returns. It keeps business activity distinct from investment activity.
Got it. And self-charged interest. That sounds a bit circular.
It is, kind of.
Yeah.
It happens when there are loans between the S-Corp and its shareholders, or maybe between the S-Corp and another partnership or S-Corp that has basically the same owners.
Okay, lending money back and forth within the ownership group.
Right. Now, normally, interest income is portfolio income, non-passive,
Mhm.
and interest expense might be deductible, maybe passive, maybe not. But with self-charged interest, if the loan money was used by the borrower in a passive activity, then some or all of the lender's interest income can be treated as passive income.
Wait, so the interest income becomes passive? Why is that good?
Because it means the shareholder who received the interest income might be able to use their passive losses to offset it. Normally, you can't use passive losses against portfolio interest income, so this rule can actually be helpful. It allows an offset that wouldn't otherwise exist. The S-Corp needs to report the details of the K-1 so the shareholder can apply the rule correctly. 3. Unpacking deductions, where tax savings lie.
Okay, wow. We've covered a lot on reporting and classifying activities. Now let's get to the part everyone's waiting for, deductions. This is really where you can directly impact the tax bill, right? Where the tax savings often hide. What are the typical deductible expenses for an S-Corp and where do they go on the form?
Absolutely. Deductions are where the action is for reducing taxable income. On Form 1120-S, the main place you'll see these is lines 7 through 20 on page 1.
Okay.
This covers all the common costs of running the business. Things like compensation for officers, salaries and wages for other employees, rent payments, taxes the business pays, business interest expense, depreciation on assets, advertising costs, repairs, supplies, the usual suspect.
The day-to-day operational costs.
Exactly. But the key thing to remember is that only deductions directly tied to the corporation's active trade or business activities belong here on page 1. If a deduction is related to something else, like portfolio income, or if it's subject to limitations at the shareholder level, like charitable contributions, it gets reported separately on Schedule K for the shareholders to deal with. Got it. Page 1 is for the core business deductions. Now, speaking of compensation, you mentioned officer compensation. This sounds like that reasonable compensation issue, which I hear is a real hot button for S-Corp.
It is absolutely a hot button. Probably one of the biggest areas of IRS scrutiny for S corporations.
Why is it such a big deal?
Okay, so remember how S corp profits pass through. Shareholders can take distributions of those profits, and distributions generally aren't subject to payroll taxes, FICA, Social Security, Medicare, and unemployment taxes. Wages, on the other hand, are subject to those taxes.
So owners might want to call everything a distribution instead of a wage to save on payroll taxes.
Precisely the temptation. But the IRS rule is very clear. If an S-corp owner, who is also an officer or employee performing services for the company, receives payments, those payments must be treated as wages to the extent they represent reasonable compensation for the services they actually performed.
Reasonable compensation. How is that determined? That sounds subjective. It can be. There's no single magic formula. The IRS looks at factors like the person's duties, their experience, the time they spend, what similar businesses pay for similar roles, the company's financial performance. It's a facts and circumstances test.
And if the IRS thinks the compensation isn't reasonable,
They can step in and reclassify distributions as wages. If they find that reasonable compensation wasn't paid for services, or even for capital provided by a shareholder or their family, they can adjust things. This means the S-Corp could owe back payroll taxes, plus interest and penalties. It's a major audit risk and a critical area for tax planning. You have to find that balance, minimizing payroll taxes legally, but still paying yourself a wage the IRS will see as reasonable for the work you do.
okay, definitely need to get that right. What about fringe benefits for these owner employees, like health insurance?
Good question. That's another tricky area. For shareholders who own more than 2% of the S-Corp stock.
More than 2% shareholders.
Right. If the S-Corp pays for certain fringe benefits for them, like health insurance premiums, those amounts generally have to be included in the shareholders' wages, reported on their Form W-2.
So it increases their wages.
It does. The S-Corp gets to deduct it as compensation expense. But then, the shareholder might be able to turn around and deduct those health insurance premiums on their personal tax return on Schedule 1 of Form 1040 as a self-employed health insurance deduction.
Ah, okay, so it flows through. What about shareholders owning 2% or less?
For them, fringe benefits are generally treated the same way as for any regular employee, meaning they usually aren't added to wages and the corporation deducts them as employee benefits. It's a nuance, but getting it right can optimize the tax situation.
So proper compensation, reasonable wages, handling fringes correctly, all key. Now, what about those uniform capitalization rules, UCR? You mentioned the small business exception earlier. Can we revisit that?
Yeah, absolutely. So the general rule, UCR, says businesses often have to capitalize certain costs related to producing property or buying property for resale. Instead of deducting the cost immediately, it becomes part of the asset's cost basis and gets recovered over time, like through depreciation or when sold.
Which ties up the deduction.
Exactly. But that crucial tax-saving alert, the small business taxpayer, is exempt from these UCR rules.
Remind us of the definition again?
Average annual gross receipts of $30 million or less for the prior 3 years, and not a tax shelter, if you need that. No UCR requirement for inventory.
And the benefit is?
Massive simplification, and often faster deductions. You can generally deduct those costs much sooner than if you had to capitalize them. It's a significant tax deferral and cash flow advantage, a real win for qualifying businesses.
That small business taxpayer status seems incredibly valuable.
Okay, what about costs when you're just starting a business? All those expenses before you even open the doors, can you deduct those? Yes, partially. S-Corp can elect to deduct a limited amount, currently up to $5,000 of business startup costs, and another $5,000 of organizational costs in the year the business begins.
Okay, a little bit up front. What about the rest?
Any costs above those $5,000 thresholds generally have to be amortized, meaning deducted ratably or spread out evenly over a period of 180 months. That's 15 years. And that amortization starts in the month the active trade or business actually begins operations.
15 years is a long time.
It is. And here's the important aha moment. The election to either deduct that initial amount or to amortize the costs. It's irrevocable. You make the choice on your first return, and you're stuck with it. So it requires some thought up front. These deductions or amortizations show up on line 20 of the 1120S.
Irrevocable. Good to know. Okay, another potentially big one. Business interest expense limitation. Section 163, Jack. This sounds complicated, but I bet there's a small business angle.
You are anticipating correctly again. Yes, Section 163, Jake, generally limits the amount of business interest expense a business can deduct each year.
How does the limit work?
The deduction is typically limited to the sum of your business interest income for the year, plus 30% of your adjusted taxable income, which is roughly EBITDA for many businesses, plus any FLIR plan financing interest, which mainly applies to vehicle dealers.
Okay, 30% of adjusted taxable income is the key part for most.
Right. This limitation applies at the S-corp level. Any interest expense that gets disallowed because of this limit isn't lost forever. It gets carried forward to future years by the corporation.
But the small business exception?
The huge tax-saving opportunity. A small business taxpayer, again, that $30 million or less average gross receipts test, not a tax shelter, is not subject to this business interest expense limitation.
So they can deduct all their business interests.
Generally, yes. If they meet the small business taxpayer definition, they can deduct all their qualifying business interest expense without hitting that 30% ceiling. This is a massive benefit, especially for businesses that use debt financing for growth or operations. It allows them to fully deduct their borrowing costs, which would be a substantial tax saving.
That's fantastic for smaller growing companies. Okay, let's flip it. What about expenses that are just not deductible? No way, no how. Where do businesses get tripped up here? Any surprises?
Oh, definitely. This is where, like you said, the devil's in the details. Lots of things businesses pay for just aren't deductible, and sometimes the rules have quirky exceptions. Let's hit some common traps.
Okay, lay them on me.
All right. First, payments related to sexual harassment or sexual abuse settlements, if they're subject to a non-disclosure agreement. Those amounts, including attorney fees, are generally non-deductible.
Okay, that's specific.
Very. Second, expenses related to generating tax-exempt income. If the income isn't taxed, the expenses to earn it aren't deductible. Makes sense. Third, fines or penalties paid to a government for breaking a law. Generally, no deduction. But here are the critical exceptions that can save you tax money.
Exceptions to the fine penalty rule.
Yes. You can often deduct amounts that are clearly for restitution, like paying damages to someone harmed, or cleaning up environmental damage you caused. Also, amounts paid specifically to come into compliance with the law, say, installing required safety equipment after you were cited, and payments from court orders or agreements where the government isn't actually a party.
So fixing the problem or making amends can be deductible, but the fine itself isn't.
Generally, yes, but here's a crucial nuance. Paying the government back for their costs of investigating you or litigating against you, not deductible. That distinction is vital.
Okay, that's a tricky line. What else is non-deductible?
Qualified transportation fringes, or QTFs. This surprises many employers. You generally cannot deduct the cost of providing benefits like commuter transit passes, van pooling, or qualified parking to your employees.
Wow, even though it's a benefit for employees.
Even so, the deduction for the employer was eliminated. And then there's entertainment expenses. Broadly non-deductible now. Costs for entertaining clients or customers' meals, unless they meet the 50% business meal rules. Tickets, club dues, facility costs generally, no deduction.
Not even business meals.
Business meals might be 50% deductible if they meet specific criteria, like not being lavish, taxpayer present, business discussed. But pure entertainment, no. The only tiny exception for entertainment is if the cost is treated as taxable compensation to the person receiving it, like an employee prize trip, and reported on their W-2.
So yeah, the rules on deductions and non-deductions are complex. One last thing here. How do tax credits affect deductions? Can you get both?
Generally, no double dipping. If your S-corp claims certain tax credits, like the research and development credit or the work opportunity tax credit, you often have to reduce your corresponding deductible expense.
Reduce the deduction.
Right. If you claim a credit for, say, R&D wages, you usually can't also take the full deduction for those same wages. You have to reduce the wage deduction by the amount of the credit claimed. It prevents getting a double benefit for the same dollar spent. Fair is fair, I guess.
Yeah.
4, tax calculation and payment logistics for S-corporations.
Okay, deductions and credits, lots to unpack there. So we know S-corp are mostly pass-through, shareholders pay the tax, but you mentioned exceptions. What's fascinating is that sometimes the corporation itself owes tax. What are those situations?
Right. It's a key point that can catch people off guard. While avoiding corporate tax is the main perk, there are two main situations where the S-corp itself has to calculate and pay federal income tax. Both primarily relate to conversions from C-corp status.
Okay, C-corp history again. What's the first one?
The first is the excess net passive income, ENPI tax. We touched on this earlier when discussing termination. This tax applies if two things are true at year-end. One, the S-corp has accumulated earnings and profits, AEMP, left over from its C-corp days.
Those old profits.
And two, its passive investment income, like interest, dividends, rents, royalties, is more than 25% of its total gross receipts for the year.
Okay, AENP plus lots of passive income.
If both are true, the S-corp pays a tax on that excess passive income. The rate is the highest corporate rate, currently 21%. It's a major trap for former C-corp holding investments.
Right.
The goal is to prevent using the S election just to shield passive income from corporate tax.
Got it. Avoid that ENPI tax if you can. What's the second corporate level tax?
The second is the built-in gains, big in Texas. This also mainly hits former C-corp. It applies if, at the time the C-corp converted to an S-corp, its assets were worth more than their tax basis, meaning they had unrealized built-in gains.
Appreciated assets at conversion time.
Exactly. If the S-corp then sells or disposes of those specific appreciated assets during a set period after conversion, usually the first 5 years as an S-corp, it has to pay a corporate-level tax on those recognized built-in gains.
So taxing the appreciation that happened during the C-corp years.
Precisely. It prevents C-corp from just flipping the S-switch to sell appreciated assets tax-free at the corporate level shortly after converting.
Okay, so ENPI tax and built-in gains tax are the main corporate level hits. That leads to the next question. If the S-corp might owe these taxes, does it need to make estimated tax payments during the year?
Yes, it generally does. If the S-corp expects its total corporate level tax for the year, adding up the big tax, the ENPI tax, and maybe some investment credit recapture tax from C-corp times to be $500 or more, it needs to make quarterly estimated tax payments.
It's like individuals or C-corp.
Exactly. It avoids a big surprise tax bill when the return is filed and, more importantly, avoids penalties for underpaying estimated taxes throughout the year.
How do they make these payments? Is there a standard way?
The standard and really required way is electronically through the Electronic Fund Transfer Payment System, or EFTPS.
EFTPS, okay.
well-
Any timing tricks there?
Yes, a crucial one. For an EFTPS payment to be considered on time, you have to schedule it no later than 8 p.m. Eastern Time the day before the payment is actually due.
The day before, not the day of.
Not the day of, by 8 p.m. Eastern the day before. And if you use a third-party payroll service or tax preparer to make the payments for you, check their deadlines, because they might need the info even earlier to meet the IRS cutoff. Don't get caught out by that timing. Shareholder reporting and key elections for enhanced tax outcomes.
Okay, corp taxes and payments, got it. Now, let's really focus on where the pass-through action happens. Schedule K and Schedule K1. What are these, and why are they so absolutely central to how S-corp work?
They are truly the heart of the pass-through mechanism. Schedule K is part of the main Form 1120-S, and it summarizes all the different categories of income, deductions, credits, etc. for the entire corporation for the year.
The total pie.
Exactly. Then, Schedule K1 takes that total pie and slices it up. Each shareholder gets their own. Schedule K1 showing the pro rata share their specific percentage of each item listed on Schedule K.
So the K1 tells each owner their piece of the action.
Precisely. It translates the S-corp's overall results into the specific numbers each shareholder needs to report on their personal income tax return, their Form 1040. Things like their share of ordinary business income, rental income, interest, dividends, credits. It's all broken down on the K1.
And the S-corp has to give these out.
Absolutely required. The corporation must provide a K1 to every shareholder by the due date of the S-corp's tax return, including extensions. Shareholders often can't file their personal returns accurately until they get that K1. Those little codes in the boxes on the K1 are super important too. They tell the shareholder exactly which line on their personal return each item goes on.
Okay. Any subtle details about K1 reporting we should know?
One we mentioned briefly before. If the S-corp did have to pay that excess net passive income tax, the passive income items reported on the K1s must first be reduced by each shareholder's share of that tax.
Ah, so they don't pay tax personally on income the corporation already paid tax on.
Correct. It prevents that specific type of double taxation at the corporate level from happening again at the shareholder level. It's an important adjustment for accuracy.
Makes sense. Okay, let's talk about a big one for shareholders. The Qualified Business Income, or QBI, deduction, Section 199A. This came out of the Tax Cuts and Jobs Act, right? How does this work for S-Corp owners, and what's the S-Corp's role?
Yes, the QBI deduction is a major potential benefit. It can allow owners of pass-through businesses to deduct up to 20% of their qualified business income. Crucially, the deduction itself is calculated and claimed on the shareholder's personal tax return.
Okay, it's a personal deduction.
Right, but the S-Corp plays a vital role because it has to provide all the necessary information on the Schedule K-1 for the shareholder to figure out their deduction.
What kind of information?
The K-1 needs to report the shareholder's share of the S-Corp's qualified items of income, gain, deduction, and loss. It also needs to report their share of the W-2 wages paid by the S-Corp, and their share of the unadjusted basis immediately after acquisition, or UBIA, of qualified property the S-Corp owns. These last two wages and UBIA become important limitation factors for higher income shareholders.
Okay, income, wages, property basis.
Hmm.
Got it. What about things that don't qualify for QBI? Are there exclusions?
Yes, and this is critical. The biggest exclusion is for income from what's called a specified service trade or business, or SSTB.
SSTB, what falls into that category?
It includes businesses primarily providing services in fields like health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services.
So it's a lot of professional services.
Right. And crucially, it also includes this catch-all.
Huh.
Any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners.
Reputation or skill, that sounds broad.
It is broad. Think celebrity endorsements, licensing your image, getting paid for appearances. If the S-Corp is classified as an SSTB, then for shareholders whose personal taxable income is above certain thresholds, the QBI deduction from that business is either limited or completely phased out.
So being an SSTB can kill the QBI deduction for higher income owners.
It often can, yes. Other things excluded from QBI include capital gains and losses, most dividends, most interest income, and wages received as an employee. QBI is really meant for the operating profit of an active trade or business.
Okay, so how does the S-Corp help the shareholder navigate this?
Here's the key tax-saving tip, or maybe tax compliance necessity. The S-Corp must separately identify on the K-1 the QBI-related items for each trade or business it operates, and it has to indicate if any of those businesses are SSTBs.
Why separately for each business?
Because a shareholder might have income below the threshold for one business and get the full QBI deduction, but be above the threshold for an SSTB and get no deduction. Or the wage UBIA limitations might apply differently. This detailed reporting from the S-Corp is absolutely essential for the shareholder to accurately calculate their personal QBI deduction and maximize their tax savings within the rules. Without that breakdown, the shareholder is flying blind.
That's a huge responsibility for the S-Corp's reporting. Okay, beyond QBI, are there other strategic elections the S-Corp can make that really affect shareholders' tax outcomes? Maybe how they report income or track their basis?
Oh, absolutely. There are several important elections made at the S-Corp level that directly impact the shareholders. They often involve timing or the character of income or distributions.
Like what?
Well, one area is how income and loss are allocated if a shareholder leaves during the year. Normally, you just prorate everything based on days owned. But if a shareholder terminates their entire interest,
Sells all their stock, for example.
right, the S-Corp can elect, if all affected shareholders agree, to treat the tax year as two separate short tax years, one ending on the date the shareholder left. This means income and losses are allocated based on what actually happened during each specific period. It's often called closing the books.
Why would you do that?
It provides a much more accurate allocation, especially if income or losses were lumpy during the year. It prevents the departing shareholder from getting stuck with income earned after they left or missing out on losses incurred while they were still there. There's a similar election for certain other qualifying dispositions of stock, too. More precise allocation.
Okay, that makes sense for fairness.
What else? Another really strategic area involves distributions, especially if the S-Corp has that old C-Corp AEMP in its books. Remember, Schedule M2 tracks different pots of equity?
All right, AAA, AEMP.
Exactly. Normally, distributions come out of the Accumulated Adjustments account, AAA first, which is usually tax-free return of basis, then from AE&P, which is a taxable dividend.
Yeah.
But the S-Corp can elect, again with shareholder consent, to flip that order and distribute the AE&P first.
Wait, why would you choose to pay out taxable dividends first?
It sounds counterintuitive, right?
Hmm.
But it can be a strategic move to intentionally drain that AE&P account. Why? To get rid of it. If you eliminate AE&P, you no longer have to worry about that nasty excess net passive income tax we talked about earlier, even if you have tons of passive income. It's a way to proactively manage that risk.
Pay a little tax now to avoid a bigger potential tax later. Clever.
It can be. It really highlights why accurately tracking those Schedule M2 accounts, AAA, AEMP, the Other Adjustments Account, OAA,
Yeah.
previously taxed income, PTI, is so fundamental. It dictates the tax treatment of every dollar distributed and allows for this kind of strategic planning.
So these elections show there's real stratagem involved, not just compliance. It's about making informed choices.
Okay, after digging through all this complexity, what's the final word on the burden? The IRS actually estimates how much time and money this takes, right?
They do. They publish these taxpayer burden estimates. For an S-Corp filing Form 1120-S and all the related schedules, the average is estimated around 60 hours of record-keeping and preparation time, and about $4,500 in total out-of-pocket costs for things like software or professional fees.
60 hours and $4,500 on average.
On average, nationally. But it varies wildly. The estimate for a small S-Corp is pretty close to that average, maybe 60 hours and almost $4,000. But for a large S-Corp, the estimate jumps to hundreds of hours and potentially tens of thousands of dollars in costs.
Yeah, those numbers really reflect the complexity we've been discussing. It shows why diligent record-keeping, understanding these detailed instructions, and making smart strategic choices are so necessary. It's not just about filing the form. It's about navigating the system effectively to avoid pitfalls and actually get the benefits the S-Corp structure is supposed to offer. The time and cost reflect the value of doing it right.
Outro. What a journey through Form 1120-S. We really peeled back the layers today, didn't we? From the basics of what an S-Corp is, to the details of accounting methods, passive activities, deductions, and those really strategic elections. I think the key takeaways are pretty clear. Understanding that S-Corp election, how to keep it, avoiding those passive income traps if you were a C-Corp, that's foundational.
Absolutely.
And then recognizing all the deduction nuances, like the specifics on fines or entertainment, knowing what's in and what's out, navigating those passive activity rules, especially knowing about that real estate professional exception.
That can be huge.
Huge. And definitely leveraging those small business taxpayer benefits whenever possible, escaping complex UCR rules, avoiding the business interest limit. That seems like free money almost.
Well, maybe not free money, but significant simplification and savings for sure. And you're right, mastering Form 1120-S isn't just about compliance, about checking boxes. It really is about strategic financial management.
Yeah.
It's about making sure the pass-through benefits actually work for you, getting profits to shareholders efficiently, deducting losses when you can, and not tripping over avoidable corporate-level taxes. It takes a proactive approach, really understanding these details, but the payoff is real financial advantage.
Definitely. So as we wrap up this deep dive, here's something for you, our listener, to think about. Knowing all this now, maybe about reasonable compensation or passive activities or those small business exceptions, what unexpected tax-saving opportunity might you see now? Maybe in your own business structure or just in a financial transaction you hadn't thought about that way before. Because, like we discovered today, sometimes the biggest savings aren't just in cutting costs, but in really understanding the rules and strategically optimizing how you use them. Thanks for joining us on The Deep Dive.